Thanks, Kiara. Good morning, ladies and gents. It's ironic that Eskom's tariff hike gets approved yesterday and I have load shedding today. That's just some of the challenges. Anyway, we're going to be talking about ISA 240 and the auditor's responsibilities for detecting fraud. A bit about my background. I've been a forensic auditor for about 22 years. I've dealt with many membership organizations like SAICA, and if you can just go to the next slide. People say, what's something interesting about you? Well, I'm a wildlife photographer and I've published 4 books. So if I had my way, I would love to be locked down in the Kruger Park or Etosha or some lovely place like that. Okay, moving on. I think we are tired of hearing about COVID-19 and pandemics, but this quote is so appropriate. Fraud has become a pandemic around the world. And if it were disease, political leaders would have to declare global health emergency. Well, this pandemic of fraud has been with us for the last few hundred years. There are 3 little CCTV clips on the screen. The first is an employee stealing his colleague's lunch. The middle lady stole 3.5 million from a school canteen. So the CCTV camera is above her. She knows that. So what she's doing, she's counting the money. She's leaning forward and pushing the money into her bra, which she does for 14 years. The third lady put through $500,000 worth of fictitious expense claims. That exceeds her salary by 20 times. And I'm saying the boss signed this off. So those are the type of things we're dealing with. And it's only going to get worse now with this COVID-19 pandemic. If we can move to the next slide. The timing is great for looking at fraud because the IRBA has set up a task group to look at guidance for auditors, which they intend publishing next month. So keep a lookout for that. If you can move on. We're going to be looking at ISA 240. It's not a lengthy document, but it contains a lot. And we're looking at the FRC version. And if we look at the next slide, you'll see the index. So we're going to be looking at the characteristics of fraud, responsibility of detecting, professional skepticism, and then we're going to look at 8 stages. So if you as an auditor are serious about adding value to the client and finding fraud, these are the recommended 8 steps. And we're going to go through each one of them in a little bit of detail. And lastly, there's an appendix, annexure, and it looks at the characteristics of fraud and it relates them to the fraud triangle. And I think most accountants and auditors understand the fraud triangle. So I'm not going to go through the fraud triangle. But at the back of ISA 240, there are 5 pages that list the red flags that we as auditors should be looking out for when doing an audit for a client. Pressure, opportunity, and rationalization. We can move on. ISA 240 says that misstatements on the financials are caused by either fraud or error. There's no in between. It's either fraud or error. And what we need to do is look to see if there is something that's wrong. Was it intentional or unintentional? So the next slide looks at the difference. What we have found is that most auditors do not look for the evidence of intent. So they find an anomaly. They go and question management. Management gives them an answer and they accept the answer because they have this relationship with management. The professional skepticism is what is missing. And all we're saying is that if there's an anomaly, management's going to give you an answer. What we need to do then is triangulate, which we'll look at a bit later. But the point I'm making here is that go and find these documents and have a look at them. You can see on the screen that 40 to 36% of all physical documents that were used in frauds were altered. And it's so easy. These people are amateurs. You will see cut and paste and all these funnies and staple holes where there shouldn't be staple holes. And they're even altering electronic documents. So you get sent a PDF. The PDF looks beautiful, but it's been tampered with. So it's critical to go and find the related documents to that invoice or delivery note or whatever it is that you're looking at. I'm sure you are like I am, where sometimes I receive an invoice and the invoice is on a Word document. And I say, wow, I could alter anything on this Word document. Even if it's on a PDF, you can take that PDF, go to these free programs online. They will convert it to a Word document, PowerPoint, Excel, you name it. So it's so easy to come up with physical forgeries and counterfeits as well as electronic ones. Moving on to the next slide. I've copied and pasted this from ISA 240. So it says, auditors should be concerned with fraud that causes a material misstatement in the financials. Now, some auditors say to me, but when we saw this amount, the amount was not material, so we ignored it. So my question is, imagine you go to the doctor examines you and he picks up a little bit of cancer in you, maybe in your shoulder. And he says, you know, it's a pinprick size. I'm not going to tell my patient about it. I don't want to worry them. And he leaves it. 18 months later, you're back at the doctor and he says, your body's riddled with cancer. And then the doctor says to you, yes, I picked up that little bit there, but I didn't want to worry you, so I didn't say anything. How are you going to feel? Same question we're asking here. That materiality is not a good word, because fraud is like a cancer. If you leave it, it gets bigger and bigger and bigger. These people that are stealing, they start out testing the system by taking 10 Rand, 100 Rand, 1,000 Rand, and it builds up and builds up, and then they're taking hundreds of thousands and they're taking millions. So it's critical to document any misstatements that you find, no matter how immaterial it is. And there are three categories of occupational fraud. You as an auditor have a responsibility of detecting two of them. So it's fraudulent financial reporting and misappropriation of assets. So on the next slide, you will see a graphic that shows you the three categories. So you're not concerned with corruption, but yes, financial statements, plus cash, which is asset misappropriation, and also inventory. So those are the areas that we have to look out for. In terms of financial statement fraud, there are 5 ways that crooked executives cook the books. So they improperly value their assets. So generally, they say they have more assets than they really do. Accounts receivable, fixed assets, and so on. They do improper disclosures, so they don't disclose things like related party transactions. They don't disclose if they had a fire or flood. They want to try and hide it from the auditors and investors. Fictitious revenues, where they, for example, create fictitious creditors, fictitious clients. They also hold the books open into the next accounting period, which creates fictitious revenue, so they are stealing from the next period. And I'm going to show you some local examples of recent frauds of how they did it. They conceal their liabilities and expenses. And of course, there's timing differences. Sorry, that's holding the books open. So they would hold the books open to the next period. Depending whether they're doing financially good or bad, they would decide, okay, any liabilities that we have now, if we're doing very well, let's push them out into the next accounting period, or let's pull in the ones from that we know we're going to incur into this period because we're doing very well. So those are some of the things to keep in mind when doing your audits. If we can move on to the next screen. Let's look at some statistics. So COSO, the Committee of Sponsoring Organizations, over 20 years had a look at the financial statement frauds that were reported to the SEC. In 20 years, the average fraud case increased from $25 million to $400 million. In the majority of cases, the CEO and CFO were involved. Those are the people we are dealing with when we are doing our audits. The average fraud lasts about 2 years. I'm saying the average. Steinhoff was 10 years, and there are others that have lasted for 10, 12 years. 1/4 of the firms change auditors near the time of the fraud. So just changing auditors doesn't mean that there's fraud. It just means we need to find out what's the reason why they are changing. Because sometimes auditors are suspicious, and it's not a disagreement about the way they're doing their work or disagreeing about the fee. It's a question of, oh, they're asking too many questions. Let's get rid of them and hire other auditors that won't ask so many questions. Characteristics of the boards were not noticeably different, but some of the boards were dominated by people, and that's what we found. I mean, if I remember, when I worked for E&Y, we used to audit Regal Treasury Bank. The CEO was very charismatic, and he dominated, and he called the shots, and we've found that in a lot of organizations where they've had fraud. And also what we call grey directors, where they are being investigated from previous companies, but nothing's happened. So we cannot just take their word for what they're telling us, because they are tainted, they are grey. So we need to keep that in mind, and that's where professional skepticism comes into it. If we can move on to the next one. So let's look at two very recent examples. Tongard Hewlett, out of those 5 categories of financial statement fraud, they used 3 of them. The ones in yellow: improperly valuing the assets, fictitious revenues, and timing differences. Nobody saw anything. Steinhoff, they did the 3 in the middle: improper disclosures, fictitious revenues, and concealed liabilities and expenses. And in the next slide, I'll give you a bit more details. The Association of Certified Fraud Examiners last month launched their report to the nation. So every 2 years, they launch their global study on occupational fraud and abuse. In this case, they looked at 2,500 cases of fraud from 125 countries. Of those 2,500, about 130 are South African. And the next slide will show you the damage done by these different fraud categories. Asset misappropriation accounts for 86% of the cases. Financial statement fraud, only 10%, but look at the damage. Cooking the books is by far the greater damage. That's when companies collapse. They're here today, gone tomorrow, and we've lost all our money. Those of you that can remember Health and Record Club, people lost their gym memberships. There were a lot of issues. People today still remember that. And Wendy Edison, the whistleblower, had to run away. She's in England now. Nobody would give her a job here. That's the reward for blowing the whistle. If any of you want to download that report, the next slide shows you where you can download it. It makes interesting reading. It's free, and you've got previous years to refer to as well. The next slide shows you that they listed the most common anti-fraud controls in sub-Saharan Africa. And you'll notice those first 5, that's the most common. So the #1 anti-fraud control that companies are implementing is the external audit of financial statements. So they're relying on you, which is the wrong thing to do. They are management. They are responsible for their fraud prevention and detection. But if you speak to management, oh, but we've got auditors. So it's critical that you make your clients aware that we're not here to find fraud. Our primary role here is to come in and look at your financials. Second one is code of conduct. That's the second most relied upon anti-fraud control. How many employees have actually read that document? How's it going to stop the fraud? Then number 3 is internal audit, management certification. Basically, those 5 top anti-fraud controls generally are not good. They're not working. We go down to the bottom, the ones least implemented. Now we start seeing, wow, these are things that actually can work. Surprise audits. How many people do surprise audits? They phone up the client and say, we're going to be there next week, Thursday, we're starting the audit. Gee, the client rushes around, makes sure he knows what department you're coming to audit. He most probably knows what you're going to ask for, because we become predictable as auditors. And he'll have everything ready for you. So when you come, everything's signed, stapled, all the I's are dotted and T's crossed, everything looks fine. One of my friends is the chief audit executive at a large listed company here in South Africa. And what she will do, she will contact one of her dealers and say, I'm coming to do the audit. It's starting on the 16th of June. Please be ready. This is what I want to look at. On the 16th of June, she does not arrive there. She arrives somewhere else unannounced. you must see how much anomalies she's picking up. And she keeps everybody on their toes because she knows how, they all know how she operates. And they're thinking, is it going to be me that she's going to pop in with a surprise visit? But you need the backing of your bosses and management to do those type of things. Okay, the next slide will show you, we're going to look at responsibility. Who is responsible for this thing called fraud? I want to go through on the next slide to a history of auditing. If we go back to the 1900s, early 1900s, fraud detection was a primary objective of the audit. We're not saying that primary objective, we are saying a primary objective. But it became too onerous, so in the 1920s to 60s, it was a responsibility not assumed. Auditors said, we don't want this responsibility. The 60s to the 80s was performed in accordance with GAS, and since the 80s, the focus has been on material misstatement. And that, ladies and gents, is why we as auditors are not finding it, because we're focusing on this thing called materiality. And as I mentioned earlier, fraud is like cancer, starting out small and growing over time. Let's have a look at the next slide. This company, Matthews International, Cynthia Mills stole $13 million over 14 audited years. The company fired PwC. You're at fault, they said. PwC fired back saying, no, 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 you are at fault, management. And we're saying we don't want to get to that stage, ladies and gents, where auditors are blaming the client's blaming the auditors. We should be working together to fight the fraudsters. Let's have a look at another case on the next slide. This lady now defrauded $54 million from the city of Dixon. That's Ronald Reagan's hometown. Dixon blamed the lax auditors. And as you'll see here, in the court case, they said the auditors never took any of the standard steps to try and verify the work. They just accepted what management told them without going and double checking. Then the prosecutor there is pointing at a logo. So what this lady would do, she was the treasurer. She would create fake invoices, but forget to put the logo on. So he's pointing at the logo and saying, auditors, surely you would look and see that the logo is missing or that the fonts are different. You didn't look at anything. So what happened is the judge ruled, that in that case it's America, the jury ruled in their favor. They said, you are guilty, Clifton Larson Allen, and you must pay back $40 million, which is 20 years worth of auditing fees. I say both are guilty. Management is just as guilty as the auditors, but the jury didn't see it that way. They said primary responsibility is the auditors, because the auditors were actually doing her tax. And they're saying, how could you not see that this lady earns $80,000 a year, but she owns 400 horses and ranches and 5 cars? Didn't you not put the two together? Did you not have a look at that? So that's one of the things that they looked at there. Okay, so the next slide, we're going to look at this thing called professional skepticism. And the next slide shows you what is professional skepticism. So we look at 6 parts. Number 1, we need a questioning mind. We mustn't be satisfied with what management tells us. We need to keep asking questions. Like a little kid, you become annoyed with a kid, but that's what we need to do. It's not a popularity contest. We are there to find out answers to the questions. We mustn't prejudge people. So the person's got dirty fingernails, or this person looks suspicious. No, let's hold our judgment. Because most times these are fraudsters with the clean fingernails, and they smile, and they're very wealthy, and they've got clean cars. We need a desire to search for knowledge. We want answers. We need to understand people and realize that people do lie, cheat, and steal, including CEOs and CFOs. We need, number 5, to have self-confidence, to resist persuasion, and even go around management if they are standing in our way, and have the autonomy and independence to go and look for things if we think something is not right. I don't know if you've heard of Cynthia Cooper. She was the chief audit executive for WorldCom. She was called in to look at something that looked strange. She started investigating. The CFO asked her twice, do not interfere. She said, I can't do that. So, well, to herself. The CFO told her, stop now. She carried on. He told her again, stop. And then what she did, her and her team work in secret and at night. And that's how she exposed the fraud. And right at the bottom, she's written a book and she said, I was worried. I didn't know who I could trust. I thought I could be fired or something could even happen to me physically. And the next step was WorldCom crashed. She's a hero now, but yes, some whistleblowers do get killed. That's the risk we take of doing what is right. The next slide will show you what is auditor objectivity and skepticism. And it all starts, ladies and gents, with your attributes, your knowledge, your skills. That's our training. From our training comes our attitude, our mindset. We must assume neither honesty nor dishonesty. We need to try and be neutral. And based on that training, our attributes, and our objectivity, will come our actions. So what we found is that most auditors that we are dealing with have the attributes. They've been taught. They know what they should do. But their mindset, their attitude is wrong. Oh, but if I do this, the client maybe won't like it. Or my boss tells me to stop it. So that impacts the action. So the attitude is critical. On the next slide, I've got a quote from Sam Anton. He was the former CFO and CPA and convicted fraudster of a company called Crazy Eddie. The information is still on the website, on the internet. And he said, as a criminal, I feared only two things, skepticism and cynicism. And the auditors that audited me showed neither. And he showed you what he did. He would get his employees, female employees in miniskirts, to go and socialize with the audit partners and audit managers. His boss, the CEO at Crazy Eddie, actually put him through articles. He worked for a few years at one of the firms that later merged to become KPMG, Pete Marwick, I think it was. And then he resigned, became the CFO, and then hired them to come and audit him. So he knew the people that were coming, he knew what questions they would ask and so on. They've got a strategy, and that's what I'm saying. What is our strategy as management and auditors to catch these people? The next slide shows the professional skepticism continuum. So if we have a look here, neutrality. This professional skepticism does not start at complete trust. It starts at neutrality. We must not bring trust into it, but you will notice that the trust and neutrality overlaps. We've got to be reasonable here because there will always be some sort of bias in us. We've been auditing this person for 20 years or 10 years. We know them, we like them, we may even socialize with them. So there's going to be some element of trust. And on the other side, of course, there will be some doubt where I don't like people that dress like that, so I might have some presumptive doubt. And it's critical to stay in the middle, in neutrality. As a forensic auditor, I tend to live in presumptive doubt. I've seen too many people doing bad things. So I don't even go to neutrality. My job won't allow that. If you want to download this document, the next slide shows you where you can download it from. It's a free resource. It makes interesting reading. The next slide, we're going to go on to section C. Okay, so we're going to look now at the 8 parts. So this is the critical part. How should we as auditors audit when we go into a client? And the next slide shows a graphic of the 8 steps. It starts with brainstorming. So the next slide is brainstorming, and it starts from the audit planning stage. So what we should be doing as an audit team is sit down and discuss amongst ourselves. We are going now to audit this bank or this manufacturer. What did they look like last year? What did their competitors that we audited look like? What should we see when we go there? So if for example, now the economy is in a slump. People are not making money. People are being fired, retrenched. When we go to audit our client and we see they are making hundreds of millions, we need to be skeptical and say, how are they doing it? Not just accept it. Oh, they're making money. That's great. They're very lucky. How are they making money in this current economic climate? And we need to keep in mind that we are dealing with management, and management can override any control in the business because they are management. They have that seniority to be able to do that. So if we go to the next slide, number 2, obtaining risk information. We need to make inquiries of management and others. And often auditors say to me, oh, are we allowed to go and speak to other people? I say, of course you can. You must go and speak to other people. Ask, and it's critical to ask questions like when we do our audit, to say, well, I'm doing the audit here. Part of my job is to look at the ethics of the business, and have you seen anything unethical? If you did see anything unethical, what would you do? Would you report it? Would you not report it? And that starts giving you a feel of the ethics or lack thereof in the business. Last year, I did a 3-day training course for a group of auditors from one of the big 4 firms. And I said, this is how you must audit. They said to me, we could never ask those types of questions. The partner in our induction said we should not ask questions that made our clients feel uncomfortable. That's the current state, generally, ladies and gents, of auditing. We must not make the client feel uncomfortable, I'm sad to say. The next slide is another quote from Sam Anton. We never feared the auditors. Until the accounting profession learns the skill of questioning, the criminal will continue to have the upper hand. Remember, he's the same one that said, the only 2 things I feared was cynicism and skepticism. And the auditors demonstrated none of it. So I mentioned earlier triangulation. The next slide shows you what is triangulation. So it starts off where we go to management and we speak to them and ask them questions, and they show us their journals and ledgers. We then need to go to number 2, management informational intermediaries. That could be IT, HR, procurement, and confirm what management has told us. But remember, management controls both of them. So management could still influence number 2. Hence, we need to go to number 3, which is customers, suppliers, competitors, regulators, and start building our picture of our client from there. So, and those 3 sources of evidence are not substitutes. So you don't substitute one for the other. We need all 3 together. And the next slide shows you how that works. So management business representations doesn't get you anywhere near reasonable assurance, ladies and gents. We are not asking for absolute assurance. We can never give absolute assurance, but we want at least 80 to 90% reasonable assurance. So management gives us an answer. We then go to the informational intermediaries. They then confirm what management says. Now we feel a bit better because it adds credibility to what management has said. And that's why you see that line going up. It's added, okay, what management told us, IT or HR confirmed. We then go to the external business states. And what if they tell us something that also confirms, now we've got reasonable assurance. If we go to the next slide, identifying business risks. So there we would look at things like the fraud triangle, which, as I mentioned, there's 5 pages at the back of ISA 240. I'm not going to go into that now. The important one is the fraud exposure rectangle. So then if we move on to the next slide, that book called Fraud Examination, the authors say that the way we should be auditing is not to look at the debits and credits balance. Because as management, we will make sure the debits and credits balance. We should be focusing on the changes. What changed from last year to this year? And we should be looking at non-financial performance measures and looking for the discrepancies. Let me put it graphically. The next slide shows it to you nicely. The 4 things we need to look at is, number 1, management and directors. We need to actually look at the people and analyze them. Look for related party transactions at number 2. Compare our client to the industry, to its Competitors, how is it doing compared to its competitors? Why is it doing so much better or worse, whatever? And then we look at the financial results and operating characteristics. So that's basically the 4 methods. The next slide shows you the PwC results for Tongaat Hewlett. They were recognizing revenue in earlier reporting periods. So what was happening, Tongaat Hewlett was trying to sell property. So they own a lot of sugarcane on the North Coast. So they are selling off the property. So the sale does not go through by financial year end, but they put it through as a sale. When it eventually does go through a month later or 3 months later, they're simply backdated. So they are stealing the sales from the next accounting period. Expenses were being capitalized as assets. Revenue pertaining to sugar sales was overstated. And then at the bottom shows you the non-financial indicators. Culture of deference. Deference means I just accept whatever management tells me to do. No matter how good or bad it is, I simply accept it. It's just the way it is. And I don't challenge management. Governance failures, policies, guidelines were not being followed. And this is stuff that people would have known. Auditors should have known this because they are there auditing, looking, talking to people, asking questions, aren't they? Or they're simply sitting in an office talking to each other, looking at pieces of paper. Because in that way, as auditors, we're not going to pick up anything. The next slide shows us Steinhoff. Off-balance sheet related party entities. So the senior people within Steinhoff owned these related parties and were dealing with Steinhoff. And anything bad, they would push off onto these off-balance sheet special purpose entities. When the auditors came to audit, they weren't aware of these bad things. When the auditors go, they then pull them back into the business. And you'll notice there that in yellow, the senior people for the last few years were already being investigated for tax evasion, document forgery, and fraud. Goes back to number 1 of the fraud exposure rectangle. The next slide will show you King 4 says you must have disclosure. So if we have a look here, Principle 1, wow, there's nearly a page. Principle 2, there's nearly 2 pages, which relates to ethics and integrity. Principle 3, which relates to anti-fraud. Look how much they're doing. This is Steinhoff, ladies and gents. That was in October 27. A month later, the CEO has resigned. Even You magazine found out that he's a party animal, tyrant, snob, moneymaker, which came out in a few books that have been written about it. And I'm saying the people that would have been around him should have picked up these type of things and been questioning, can we rely on what this person is telling us? Because we have seen all these other character attributes that don't make us feel comfortable. Now, what auditors normally say to me is, where in our statements do we find these things that you're telling us, this fraud exposure rectangle? So if we go to the next slide, I say 315. Principles 2, 3, and 4. If we go to the next slide, Principle 1, the management and directors. Have you considered the integrity of your client? Or do we just accept what they say? We don't look at their character, their personalities. Are they being investigated for fraud? Have they lied to me in the past? And the next slide goes a bit further. We must look at the integrity of our client because that will dictate whether we are neutral in our skepticism or whether we're saying, hey, something may be wrong here. Let me dig a bit deeper. Let's carry on to the next slide and have a look at now number 4. Professional judgment. We need to assess what the entity has been doing. And then if you have a look here, these are the 10 building blocks. So as auditors, we should be coming in when we audit to say, have you done fraud risk assessments? When last did you do it? What was picked up? Are your internal controls fraud resistant? Or do you, for example, just have a sign over the door that says no unauthorized entrance? Because that's not a very good control. We need to have dual key control. Segregation of duties. Are you doing training and awareness? When last were your people trained? Was there a transfer of skills? And so on. If we go now to number 5, sorry, that relates to COSO. That's why they're colored in the blocks. So now, depending on what we find when we've been asking our questions and identifying and assessing our risks, we need to decide, must I alter the way I'm doing the audit? Must I change the nature, timing? Must I perform extra procedures based on what I found? Because some auditors say to me, no, we need to stick to our audit plan. I said, no, that's only a plan. It's to give you guidance. Depending on what you find, you will alter and change your plan going forward. You don't stick to your plan. Unless there's nothing that you find, obviously. Then we look at number 6. What we found, is there evidence of fraud? Now, in order to prove fraud, if we have to go to court, there are 4 things we have to prove. Was there prejudice? Was the act unlawful? Was there misrepresentation? Was there intent? If not, if the misrepresentation is missing, we're left with 3 things. That means it's theft. Or if we can't prove those 3 things, then it's a mistake. That's the way we would do it. We look now at the next one, number 7, communication. Whenever you find something, ladies and gents, please bring it to the attention of your client. Sometimes auditors say to me, you know, it was immaterial, so I didn't tell the client. Remember, fraud is a cancer. It grows. Rather, you make a note, tell your client, I found this is missing. Whether the client wants to take action or not is his problem. If that little bit of fraud becomes a big cancer, they cannot then come and blame you and say, you are the auditors, because that's what they're going to say. You are the auditors. Where were you? You are responsible. You can say, I brought this up on the last 3 annual audits. I made a note of these missing items, the missing money. Management, what did you do about it? You told me not to worry about it. Okay, so critical to document what you find. I carry a little booklet with me. If I get a phone call, I straight away take my booklet out and write down whoever I'm talking to. If I'm in the office, I'll write it down on my phone. I write it down somewhere, because what's going to happen, we're going to get to court and the opposition's attorney is going to say to us, what did you have for breakfast last week, Wednesday? And I can't remember. I don't think you can. And he's going to say, but you got the gall to stand here and tell me what my client said or what was on his desk 6 months ago or 2 years ago. That's when we can say, I don't have to remember. I wrote it down. I took a photograph. That's the other thing we found with auditors. They will be auditing. They will take a sample of documents. They will find maybe some of them are not dated, signed, or stamped. They put the documents back. Then they make their report available to management. Management picks up the phone, says, bring me those documents. They fix them. And at the audit committee meeting, they say to the auditor, these things you picked up, we went to look for them. Where are they? They're not here. What are you talking about? You look like a fool. I look like a fool. Whereas we could say, no, I photocopied the documents. Here they are. You've now changed them afterwards. I photographed them. Here's what I found. Or don't put them back. As auditors, keep those documents. Give your report in and then see what management says. I want to end, ladies and gents, on another quote from our friend Sam Anton. He says, do not trust, just verify, verify, verify. The inclination to trust and the presumption of innocence gives the fraudsters the initial benefit of any doubt while they're free to plan and execute their crimes. So all I'm saying is, on that skepticism continuum, don't migrate towards the left. I know it's tempting to want to like the client and socialize with the client and believe the client, but it's not going to do us any favors. Rather, stay towards the middle or towards the right. And that concludes the presentation. We will make it available. If you'll just let SAICA know, if you want a copy, they will then email them to you. If there's any questions, they will also email them to me and I will try my best to answer them. Thank you very much, ladies and gentlemen. I think this was a good session. I always wondered what happened behind the scenes of these webinars. I don't have to wonder anymore. A lot of sweating, running around, but it was a success at the end of the day. Thank you very much, and we hope to see you on the next one.